House prices are falling. Let's have a look. Good morning, everyone. Florian.Heise here, and welcome to another episode of HeiseSays. I have my morning stein of coffee, and then I'm nearly halfway through already. And I thought we'd have a look at this article from the ABC discussing, well, the effect of the economic lockdown and the pandemic on house prices. Australia is house mad. We're property mad. Property prices have grown significantly since just 2006, just this data. It looks even worse if you go back to 2000. Houses are quite expensive, and everyone's interested, either as a first home buyer trying to get in, or as an investor using it to minimize their tax, or as someone about to enter retirement and wanting to downsize and cash out. We are property obsessed. I don't think anyone would argue that. And you'll see in these articles, we'll have one, property shooting up, property going down. I've got one here. We're looking now. One discussing property prices worsening. And then I have another one I found where they're talking about double-digit price growth in property. What I'm starting to realize is that, well, often you'll get media organizations that make cherry-pick data. And the way we try and deal with that is to look at different things. And the one advice I'd give everyone is do not be afraid to go a bit slow. Particularly if you're a buyer. There'll always be more houses. Don't worry, they're not suddenly all going to disappear. Don't let your emotions get the better of you. So let's have a look at this. The pandemic-induced slide in Australian housing values accelerated last month as more sellers put their homes on the market. CoreLogic's monthly home value index, remember it used to be daily? It's funny how that stopped. Just in line with RBA's potential intervention into the market. Oh well, don't worry. They'll just shut down the housing market if it gets too bad. CoreLogic's monthly home value index showed a 0.7% fall in values nationally, led by a 0.8% drop in capital city prices. The biggest capital city falls were in Melbourne and Perth, which both recorded a 1.1% decline, while Sydney had a 0.8% drop in values. Brisbane and Adelaide posted smaller declines, as did regional areas, which fell 0.2%. I think for those of us living up here in Brisbane, I think if there is a sharp correction in property, particularly in Sydney and Melbourne, I don't know if we'll experience it as bad, because, well, if you look at our growth, it just hasn't been as high as some of the other cities. But Sydney, Melbourne, and I think, what is the next one? Canberra. But Hobart, look at Hobart there. Their growth from 2006 is now fighting with Sydney for second place. Hobart. I mean, don't get me wrong. Hobart's a beautiful city. I remember when I travelled down to Tasmania for university or for work. And I'd be talking to people there and they'd be saying how much houses cost. I would get insanely jealous at how cheap some of these beautiful old houses were. The only problem was you needed a fireplace that actually worked because it was cold down there. You can see here on the map, For those foreigners, that's Hobart. Pretty much the end of civilization at the bottom of the world. So it gets a bit cold. The smaller capital cities, Hobart, Darwin and Canberra, defied the falls elsewhere with modest gains. So price falls are expected to continue. They're expected to continue. And we'll just keep this in mind. We're having, yesterday, experts are predicting falls in property. You've got all the mechanisms, interventions into the economy are going to end in September. All the support mechanisms. And small business, which is a huge part of the economy. We may not be a huge part of the lobbying effort or Aldi bags to politicians, but small business is a huge part of the economy. And I think small business owners have copped it much worse than big business. Much worse. So, price falls are expected to continue. However, CoreLogic's head of research, Australia, Eliza Owen, said most analysts are expecting price declines to continue, with a peak-to-trough fall nationally of about 10%. There's definitely some headwinds and risks that lie ahead for the market, she told ABC News. See, here's the thing. These movements in property is going to be slow. It's going to take time. Go back and look at the Great Depression, the share market there. It didn't just happen overnight. It took some time. I'm just going to adjust this. It took some time. It took some time. So this isn't going to be overnight, guys. You're not going to wake up and all of a sudden property has crashed. It'll be months. It's not as exciting as some of the other markets, which is a good thing. Honestly, which I think is a good thing. It'll be, you'll reflect back on a couple of years going, wow, that house value, it's gone down. These include a sustained rate of high unemployment, with the cash rate unlikely to go any lower. It really does come back to labour market fundamentals to improve purchasing capacity for housing. Well, here's the thing. It's not just the high rate of unemployment. Its international demand is pretty much dried up. Tourism has dried up, so you'll see more of those properties flooding onto the market. International student numbers, virtually non-existent. Although I suspect they'll find a way to let all those international students in the country. Do you think there'll be lobbying going on there? The other major risk is the tapering off of fiscal stimulus and how long banks can sustain easier conditions for people trying to service mortgages amid these job and income losses. Here's the thing. We've got a culture now where even the highest educated people, even those with high professional jobs, are dependent on the good graces of the bank to keep their home. People don't have anything stashed away. They don't have anything set aside. I'm sure there are a few, there definitely are some that do. But you'd think, that we looked at another article, the project manager. Project manager, you'd be on six figures, particularly at that age. You'd have a level of seniority. And they were contemplating selling once the bank amnesty disappears, or the banks being all touchy-feely and nice and protecting their assets. It seemed quite odd to me. That was the most disturbing thing I've seen. I mean, honestly, I can appreciate how someone who's living really tight struggles to build up a emergency fund. I mean, there the challenge would just be to get $1,000 in cash for any undue emergencies before you start attacking your debt. But when you're highly paid professional, Ms. Owens said both the federal government's stimulus measures, such as JobKeeper and a boosted Job Seeker, have been extremely important in preserving stability in the housing market. So future generations are incurring that debt to keep the current housing landlords in value, in wealth. We know that for a 1% increase in the unemployment rate historically, for example, the RBA estimates there's about an 80 basis point increase in the rate of mortgage arrears, she observed. And so we'll bring up this chart from the older RBA one. Just looking at the arrears rates from 2019. So for 1% increase in unemployment, and unemployment, let's see, we've got here, has gone up to 7%, and that went from, 5% up to 7, roughly. So we'll say 2% increase, so it should be 80 basis points, so 1.6% increase to our arrears rate. That would put WA and NT at 3%, Queensland at 2.6%, and the rest of Australia from 0.5 roughly to 2%. So that's what all these mechanisms, I would imagine, are avoiding. So with about 400,000 people on these mortgage holidays, we can expect that when those start to taper out, we'll see a bit of an uplift in arrears. But hopefully, by the time we'll see a bit of an improvement in the labour force and more people back on the incomes they were before the onset of the pandemic. I think that's a little optimistic. We're entering a recession, everyone. This is going to be tough times for a couple of years. That is one reason why Ms. Owens is not currently expecting those falls to turn into a fully blown property market crash. Economic conditions seem a bit better than what was initially forecast by the RBA, and so it is likely that we're not going to see a housing market crash, she added. It's because the economy is being completely propped up by the government. The banks are not enforcing their contract conditions. They're giving people holidays. How is that going to project into increased economic activity when these mechanisms are removed? I don't understand. I don't think it will. Ms. Owens said the number of property listings is the key piece of data to watch to predict how the market may move in the short term. CoreLogic's figures show listings are up 42% from a low point in early May, but so far those extra properties for sale are finding buyers, with home sales also up more than 20% in May and nearly 30% in June. So far nationally, that's been well absorbed by high sales volumes, and so the total stock on market is still tight and still trending down, she said. We are starting to see signs of an accumulation of total stock in Sydney and Melbourne, and of course, that's where we see high levels of investment as well. I think the first part of the sector to hit will be units, everyone. Investor-grade units. Units where we had foreign investors piling in. That's where we're going to see the big hits, and we already are. I mean, building approvals in units are down 30%. 30%. Homes are different. So a first home buyer is underwriting the demand. So more government spending is what's propping up the sector. They really are throwing everything, the kitchen sink at it, aren't they? Data out this week shows owner-occupiers are picking up a bit of the slack created by investors dropping out of the property market. Credit to owner-occupiers grew by 0.5% in May, while loans to investors fell 0.3%. Recent ABS data shows first home buyers continue to make up around a third of that owner-occupier home loan demand. The latest ABS data for April show demand from first home buyers is around 20% higher than that most recent low point in December 2018, as property price falls in many markets over late 2018 and early 2019 lured them into the property market. Also attracting first home buyers more recently has been the federal government's first home loan deposit scheme, which allows some to get a loan for just 5% deposit without the need for lenders' mortgage insurance. I mean, there you go, everyone. There you go. What is this? What's this scheme for? Like, what does it remind you of? What does it remind you of? What did the states do? The initial 10,000 places for the 1920 financial year were all taken up, and this financial year's allocation of 10,000 has just opened. We'll have to see. We'll have to see how fast they fill up. But here's the thing. Our market is fundamentally different to the US. You can't send jingle mail back. You can't just abandon the mortgage and give it back to the bank and make it their problem. People are stuck with it. So you're signing yourself up to work forever to pay off that life debt. The chief customer officer of mortgage broking firm Aussie, David Smith, said first home buyer inquiries with the firm have more than doubled from the same time last year and are at record highs, despite a survey conducted for the business showing many have not heard of the deposit scheme. Initiatives like the First Home Loan Deposit Scheme in particular represent a significant opportunity for first home buyers to accelerate their home ownership goals, and yet 85% say they've never heard of the scheme, he noted in a report on the survey. The survey of just over 1,000 prospective first home buyers shows 71% wanted to take advantage of the renewed fall in home prices to buy, but 98% believed they faced challenges to buying, with more than half saying getting approved for a loan was a key challenge. So home building slumps worsen. Separate figures out today, which was yesterday, from the ABS, show the slump in home building plans is also accelerating. Building approvals from councils dropped a precipitous 16.4% in May, led by a collapse of 35% in unit and attached dwelling approvals, while detached house approvals dropped 4.4%. The numbers of dwellings approved in apartment buildings fell sharply to an 11-year low, the Bureau's head of construction and statistics, Daniel Rossi, said. That has pulled total building approvals to the lowest levels in years. Total building approvals are tracking at the lowest level since 2013, APM Capital senior economist Diana Messina wrote in a note. The decline in building approvals started in late 2017 and started bottoming in late 2019, but the pandemic has led to further falls in construction activity. She said developers were starting to anticipate the drop-off in demand for new dwellings, with immigration drying up during the pandemic. Net migration is expected to decline by around 200,000 over 2020-2021 compared to 240,000 annual increases in net migration over recent years, she observed. This will mean lower demand for new housing by around 80,000 dwellings over the next 2 years. over the next 2 years. So what do you all think? Do you think property is going to bounce back? Or do you think this will be restricted to a 10% decline? Do you think expectations that the economy is doing better than the RBA predicted is simply because the government is literally throwing everything they can? Every element of stimulus. The banks are being really nice and friendly to everyone for some reason. Will it continue past September and October? I suspect we'll start to see the real pain at the beginning of next year, when people have maybe put money aside, taking the mortgage holiday just to build up a cash reserve, and then went a bit silly at Christmas. Then the afterpay bills and the credit cards start piling in. Then people get into trouble. And the jobs aren't looking any better. What do you all think? Let us know your thoughts and opinions in the comments below. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create, there are a few ways you can. Simply watching and interacting is a great way to let YouTube know that you're enjoying the content and helps the channel grow. You can support the channel financially by joining us on YouTube or Patreon, using our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin, buying our merch from HeiseSays. You can support us using Gold Pass from the Perth Mint or via PayPal. Thanks, everyone. I'll see you in the next episode.